Good morning, dear listeners, and welcome to today's market analysis. Global markets today experienced a significant one-sided sell-off, a market dynamic we can confidently describe as a unilateral decline with a probability exceeding 90%. The central theme of capital flow is a systemic and comprehensive exit from risk assets, with substantial funds rapidly moving towards US dollar cash and short-term US Treasuries for safety. All risk assets, whether technology stocks, cryptocurrencies, commodities, or even traditional safe haven gold, were not spared, experiencing widespread selling. The market has clearly entered a typical liquidity panic mode. Let's look at the specific market performance. The Nasdaq Composite plunged by 4.18% today, closing at 25,709.43 points. The S&P 500 fell by 2.64%, settling at 7,383.74 points. Even the relatively stable Dow Jones Industrial Average saw a significant decline of 1.35%, closing at 50,866.78 points. The VIX Volatility Index, often called the fear gauge, soared by an astonishing 39.77%, reaching 21.51, unequivocally signaling systemic market panic. Simultaneously, the 10-year U.S. Treasury yield rose by 1.32% to 4.54%, and the U.S. dollar index DXY gained 0.66%, climbing above 100.07. The offshore Chinese yuan, USD/CNH, saw a 0.2% increase to 6.7888. The cryptocurrency market also faced pressure, with Bitcoin BTC dropping 3.27% to $61,642. In commodities, WTI crude oil fell 3.1% to $90.25, and spot gold was not immune, declining 2.56% to $4,353.90. The strongest asset today was US dollar cash, while the technology and AI semiconductor sectors led the downturn, with major components like Nasdaq, QQQ, and Nvidia experiencing the steepest losses. Reviewing the global trading sessions, the Asian session saw pressure on A-shares, with the Shanghai Composite falling 0.74% and the Chi-Next Index plummeting 3.2%. Funds flowed out of high-valuation growth stocks, a direct reflection of escalating geopolitical risks. The European session likely continued this weak trend. During the U.S. trading hours, the market opened lower and continued to decline throughout the day, with no effective rebound. Nasdaq futures had already dropped 4.43% pre-market, confirming this direction upon opening. We observed no significant buying interest during the day, and the VIX surge solidified the systemic market panic. Today's market presented no turning points, but rather a continuous downward trajectory. The Nasdaq and AI semiconductor sectors were both the primary drivers of sentiment and the biggest drag on the indices. Regarding today's market movement, it fully aligned with the negative pricing of escalating geopolitical tensions and recession fears, leaving little room for significant expectation gaps. Although the ISM manufacturing PMI data came in below expectations at 49.5, the market did not treat it as an unexpected negative catalyst but rather absorbed it in conjunction with geopolitical risks. All negative news, including tariff escalation, weak PMI, and recession expectations, were fully, perhaps even excessively, priced in by the market. Notably, today's market displayed signs of systemic fund outflows for 2 to 3 consecutive days. The decline initiated on June 3 was not an isolated event. Today's high-volume sell-off, particularly the VIX surge, confirms this is a panic-driven liquidity contraction, not merely a short-term correction. From the Trinity linkage perspective, the US dollar strengthened, US equities plummeted, and the 10-year US Treasury yield, despite a brief dip after data release, still closed higher at 4.54%. These three elements illustrate a typical panic-driven flight to safety: a stronger dollar, a collapsing stock market, and higher Treasury yields primarily due to selling pressure rather than pure safe haven buying. This divergence suggests that the Treasury market itself is also experiencing liquidity stress, beyond just being a safe haven allocation. This scenario undoubtedly bodes ill for Asian markets in the coming session. Hong Kong and A-share markets will directly face catch-up selling pressure upon opening, especially in technology and AI-related sectors. Looking ahead to tomorrow, Asian markets are highly likely to open significantly lower. The Shanghai Composite Index could directly test the 4,000-point psychological level, and the Chinext Index is expected to continue its lead in declines. The Nikkei and Kospi indices are also projected to follow the U.S. market's sharp fall, primarily due to catch-up selling in technology and export-related sectors. In this environment of extreme panic, if Asian markets experience a sharp decline of over 5% tomorrow, some domestic A-share companies with stable performance and no direct link to AI infrastructure might be oversold. However, given the current level of panic, attempting to bottom fish on the left side carries extremely high risks. We also need to closely monitor for any news from Beijing tomorrow that might ease geopolitical tensions, or any further economic stimulus policies from China. In summary, given the current market conditions, our strategic inclination is to adopt a defensive, wait-and-see approach, firmly avoiding all risk assets, and closely observing the opening of Asian markets. Over the next few days, market panic will likely take time to dissipate. The US dollar index is expected to maintain its strength, and the VIX Fear Index will likely remain elevated. We advise everyone to stay highly vigilant, prioritize cash holdings, and refrain from blindly attempting to catch the falling knife.